Just to recapitulate that, in the last session, we had an overview of the amendments made by the TOLA 2020 and the Finance Act 2021. Now, major amendments have been proposed in the Finance Bill 2022. The explanatory memorandum to the bill states that the purpose of all these amendments are basically twofold. One is to have align Section 1023C regime with Section 11 regime, because there are some differences. This has been an ongoing process, and therefore they want to align as much as possible in this bill. The second is, they say, to have a better control and management over the various institutions which claim full exemption. And the last one is, they say that some of the amendments are to provide clarity, because in the opinion of the lawmakers, there is a doubt in some of the provisions. So they want. So these are the three objects of the 1022. As we would see at the end, that with the alignment of Section 1023C institution and Section 11 institutions, one really wonders whether we need a Section 1023C separately at all, especially the subsections 4, 5, 5A and 6 and 6A, because we don't need them. We can stop with 1023A and move all these institutions to Section 11, so that it will be, the complexity will come down a bit. But anyway, so as of today, these two regimes continue. Yeah. Next one, please. As I was telling earlier, that what happens is that if the amount accumulated under Section 11(2) is not spent for the purpose for which it is accumulated, or it is spent for some other purpose, or it ceases to be invested in the approved modes under Section 11(5), or if it is given as a donation to some other charitable trust, then Section 11(3) earlier stated that all these things would be, in the year of violation, or rather in the immediately next year, that would be treated as income. But now Section 11(3) has been amended, and similar amendments have been made to the proviso to Section 1023C also. So we will just go through it quickly and then take up the issues on that. Now, as per the amendment, the major change is this, that if there is a violation in a particular year, it will be treated as income of the year in which the violation took place, not in the subsequent year or in 7th year in some cases, as the case may be. So therefore, this is a significant amendment to say that in respect of any violation which takes place on accumulation under Section 11(2), then it will be treated as income of the year in which the violation takes place. What are those conditions under which Section 11(2) income, if it is not accumulated, will be treated as under 11(3) income? One is, if the income is applied for purposes other than charitable religious purpose for which they were accumulated, the amount so misapplied or ceases to be accumulated will be deemed as income. So what happens is that it covers both misapplication as well as ceases to be accumulated. For instance, you accumulate for a particular purpose and you don't spend it for that purpose, but you spend it for some other purpose. That will be a case of misapplication. Or at the end of this one, it ceases to be accumulated, or before the end of 5 years, it ceases to be accumulated. You remove it from one accumulation and treat it as a part of your general funds. Then also Section 11(3) will apply. So this is one of the conditions. So next one, please. If the accumulated income does not remain invested in any of the modes under Section 11(5), then also Section 11(3) would be attracted. If the accumulated income is not spent within period of 5 years from the stated purpose, it shall be deemed to be income of at the end of the 5th year. If the accumulated income is created Yeah, so or credited or paid, not created. So this error, kindly corrected. Credited or paid as a donation to another charitable institution, then also the section 11.3 will apply. So the major change in 11.3 and section 1023C is only the shifting the year of taxability to the year of violation. That's a major change. There is not any other change much. Yes. So this is the, now what has happened is see, there was no similar provision in section 11.2 to the very same extent as was in 1023C. Though there is the third proviso to section 1023C contains certain clauses regarding accumulation, they were not fully aligned with the section 11.2. I'm taking this at this stage as a part of the simultaneous amendment, though it is actually an amendment to align section 1023C with section 11. What happens if you don't spend 85% of the income to the objects of the institution, but is accumulated either wholly or in part for application to such objects, then the income so accumulated shall not be included in total income subject to certain conditions. What are those conditions? Let's see. Please go to the other slide. The conditions are, these are all basically procedural in nature. The first condition is the institution furnishes a form in such form and manner as may prescribed. That will be done after the bill becomes an act and the relevant rules are prescribed. It will be similar to what we are filing in form. What is the form in section 11? That's section 10, form 10 or something like that. I'm not very sure. So those forms, similar forms will be there also for this. Then the condition is that you have to invest the money in approved modes. Prescribed statements should be filed on or before the due date specified under 139(1), which in the case of a 1023C institution, you have to look at section 139(4)(c), which requires you to file the returns of the certain institutions which are approved under section 23. So you must file all these things before the due date for filing the return. And on a plain reading of the section, we don't get the exemption, the accumulation benefit if you don't file it before the due date. You may have to go to the board under section 119 and make an application for continuation of delay. Next one, please. What are the issues on this? See, it is basically a difference in language between the section 11.2 and section 1023C. Now, in section 11.2, it's the expression used is accumulated or set apart, either in whole or in part, for application of such purposes in India. So look at that. It is set apart, either whole in part, for application of such purposes in India. Whereas the explanation 3 below the third proviso to section 1023C says it is accumulated or set apart either in whole or in part for the application to such objects. So there is a difference between to saying that for application of such purposes in India and for application to such objects, because objects are much more broader, whereas the purpose is much narrower. To give an example, for instance, if I say that I'm an educational institution, I can say that I'm accumulating the income which has not been applied in the year of earning to construct a school building or expansion of a particular institution's building. Then it's for a specific purpose. The other way, if it is objects, I can simply say that it is towards the objects of trust. I can even repeat the objects of trust in the resolution stating what is the purpose of accumulation. Now, next slide, please. So when the proviso says that it is for such objects one can possibly take a view that it covers the whole gamut of the objects, and there is no need for you to specifically mention what is the specific purpose for which the accumulation is made. But is this right? Let us analyze these sections as they stand now and to be proposed in the finance bill. Next slide, please. The department has always been taking a view that you have to be specific in stating your purposes. They say that merely repeating the objects of the trust or broadly stating the objects of the trust as a purpose for the purpose of accumulation, they say that is not sufficient. Therefore, according to them, they have always been rejecting such accumulation requests and taxing the unapplied income. But the courts, in a number of cases, I just given a few examples here, 1 or 2 examples, to say that both the Delhi High Court in Hotels and Restaurants Association and Karnataka High Court in Gokula Education have held that it is enough if you state the broad nature of the accumulation, which can be in accordance with your objects. In effect, even if you repeat the objects, that is sufficient. The Calcutta High Court in Trustees of Singhania Charitable Trust has taken a different view on that. But Calcutta seems to be a lone dissenter on this particular point. Next slide, please. Now let us look at the language used in explanation 3 below the third proviso, which is proposed, and say that use that language to justify that I can state my purpose as the object itself as my purpose. I'll put it that way. My object itself I can state as my purpose, because the clause A of the condition A of the explanation 3 of the third proviso says that the prescribed statement I should mention the in the main expression, the main, this one would say that it is objects. But when it comes to condition in the explanation, it says that I should mention the purpose in this accumulation statement I'm going to give. The request I'm going to, whichever form they are going to prescribe, there they use the word purpose. But when it comes to the explanation 4, which is they say that it's wholly applied for the objects. So again, the disconnect is there. So how do we utilize this disconnect to justify saying that it is enough if I mention the broad nature of the objects as a purpose? Next slide, please. Bharat, can you just go to the next slide? Yeah. Now, this different use. Now we have certain explanation 5, which is equal, which is almost similar to section 11(3) capital A, which says that if a charitable trust or a specified 1023 institution is not able to spend the amount accumulated for the stated purpose, it can make an application to the assessing officer to say that, please allow me to change the purpose for which I am accumulating, as I am not in a position to do the earlier one. And on being shown the reasonable cause, and if it is justified, the AO will grant permission for you to do that. So this is the law as we stand today. So now this explanation 5 also would have an impact on the interpretation of the purpose. Next one, please. Now look at the main section, which says that accumulation, if you are not able to spend 85% of the amount, then it says the balance amount can be accumulated for use in the objects of the trust. Okay, this is what the main section. Then we saw that the clause A of the condition states that in the form of requesting the filed with the department for accumulation, I have to mention the purpose. Okay, but when it comes to the violation of the clauses, again it says that if it is not used for the purpose of the objects of the trust. So you have a serious problem here. The main section says that object, if it's not spent for the objects of the trust, then you can accumulate for a specific object. The condition in form says it should be a purpose to be stated. Then the explanation 4 states that if you do not spend it for the objects of trust, what happens? So, and explanation 5, which we saw also, says that if you are not able to spend the amount for the purpose of for which the accumulation is made, then you make an application to the AO to change the purpose. For instance, if I had given, assuming the first view that stating the broad object itself as purpose is right, what is the meaning of this explanation 5? Why should I go to the assessing officer at all? Because I'm not changing anything which is outside my objects. The purpose is within my objects, but instead of saying, let's say in the example, instead of constructing a school building, I say I don't want to use a school building for that. I want to use that money for setting up buying some more lab equipments. Okay, which is also for the purpose of the objects of trust, which is education. So if I have said if it is for the purpose of education as the purpose in my statement, then why should I go to the assessing officer saying that there is a change? It is not there. So explanation 5 would apply only in those cases where you yourself have stated that I want to accumulate it for a specific purpose, but I'm not able to achieve that particular aim, and therefore I want to change it. But explanation 5, similarly, section 11(3) capital A, cannot be used to say that the purpose should be specific in the form. According to me, it is sufficient if you state the broad nature of the objects as purpose. That is sufficient on that basis. But what I would like to say is this: in all these cases, we have to be very careful, because until the Supreme Court decides this issue in one way or the other, there is always a Damocles sword hanging over you. If tomorrow the law becomes, or rather gets settled on the proposition advanced by the department, then all these charitable trusts will be in serious difficulties, because to the extent they have accumulated, they won't get the exemption. So therefore, you should use this, according to me, use this only as a defense. As far as possible, state the specific purpose so that you can avoid disputes. That would be my suggestion. Can we go to the next slide? Okay, before they going on this particular issue, if there are any questions on this, I would like to take. Otherwise, I'll go to the next issue.
Sir, we don't have any questions as of now, sir. So I think we can proceed.
Okay, fine. The next one is this: whether a trust which normally follows the mercantile system of accounting can provide for an accumulation. For instance, can it say that I have promised to give let's say that to give a donation, or for some other commitment I have made, let's say for the purpose of the capital expenditure, I have made a commitment, and the other person has not raised the bill, and I have not paid the amount, and therefore I create a provision or a liability for a capital expenditure incurred by me, for which the payment has not been made. So you make an entry. The trusts you should use to claim this as an application, and the courts have been allowing that an application based on the method of accounting followed by the trust. If the method of accounting followed, general method of accounting followed by the trust is a mercantile system, they used to allow that. Now, there is a proposed amendment by adding explanation to below section 11 and a similar explanation below section 1023C to say that in a case where an application is to be allowed, it has to be only on cash basis. That means there should be an actual payment of the amount. So in the example I gave you, since the trust has not paid any money to the person who has supplied the equipment or the contractor who has constructed the building, merely on the basis of provision, now from now onwards, you will not get that as an application of income. There's a question which says, which explanation is this? This is, if you see the finance bill, just one moment. Explanation 3 below section 1023C, that will be at the end of section 1023C, and similarly explanation introduced after subsection 7 of section 11. Okay, this is where the explanation is proposed to be introduced. Now it's very important to note that this particular amendment would apply only to calculating the application of income. How much you applied for the income of the trust, how much has been applied. For that purpose only you look at this. But there is nothing in this explanation which prevents you from drawing up your accounts on mercantile basis in respect of determination of your income. You can determine, you can follow either mercantile method or you can follow the cash system of accounting. It is up to you what you want to do. So for the general determination of income under section 11, you can follow your regular method of accounting. But when you come to determine the amount which has actually been applied, they say look only at the actual amount spent. No liability will be recognized as application of income. That will be recognized as application of income only in the year in which it is actually spent, even though you have created liability in your books based on your method of accounting. Next slide, please. Yeah, this also I have explained. Next one we can go. The next amendment is with reference to conditions for getting the exemption under section 11 as specified in section 12A have been amended. We had section 12A 1B of the earlier provision which said that your account should be audited, and now they are making it very clear that not only your accounts should be audited, but also you should maintain books. In the earlier condition, the maintenance of books was not specifically mentioned. So possibly what happened, an ingenious argument was set up by certain trusts, which said that okay, I'll go. There is a question on that, Mr. Rakesh, can you just repeat that question if you don't mind?
Sir, I'll allow him to speak so that he can.
Yeah, no problem.
Just a minute. Rakesh, just a minute. Let me just allow you to speak. Rakesh,
yes, am I audible?
yes, we can hear you. Yes, we can hear you. Please.
Good evening, sir. My question is that now they're proposing to mandate that the application of income, both capital and revenue, will be on cash basis. Means whatever we have paid out till 31st March, that will be considered as application income. Now, if I maintain my accounts on mercantile basis, yes, the proposal is the application will be deemed only on the cash basis, but it is totally silent on the income part. If I keep my accounts on mercantile basis, will I be permitted for computation and for ITR 7 also to account for the income on cash basis despite my income and expenditure showing the income on this accrual basis?
Okay.
Because
See,
there's
this
a dichotomy. What happened in the DTC also, sir, if you recall, long time back, the direct tax code, they tried to bring the same thing initially
they
in
want,
2000. But ultimately, in
in
the second DTC, it was again reverted back. It will be the option of the SSC whether it wants to maintain both cash or mercantile. But now it is coming out as from the proposal, it is coming out as a hybrid system.
exactly. See, in DTC, just as a matter of this one, either you have to completely follow the cash system or the accrual system of accounting.
Right, sir. Right.
Both for income determination as well as applicant. Therefore, there was no dichotomy.
Right.
But here, what is happening is on your first question, that whether when you maintain your accounts on accrual system, but for the purpose of the computation of income under section 11(1), whether you can shift to the cash system.
Right.
Now, one way of looking at is, strictly speaking, section 145, which says mandates that the income from business and income from other sources shall be determined in accordance with the regular method of accounting followed by the assessee, is not applicable to section 11 because all these computation provisions are generally not applicable. But there has been, for instance, you take the Companies Act. Companies Act, both 2013 mandates that you have to maintain for the purpose of Companies Act only on accrual basis.
For Section 8 company, it will be quite a challenge because the department.
Yeah, no, I'm just saying that. I'm just coming to that point. What I'm saying is that since but for the purpose of Income Tax Act, they are permitted to adopt cash system regularly. So they can convert their balance sheet and profit loss account, which is prepared on the basis of the mercantile system, to a balance sheet and profit loss account on cash system. For Companies Act, you continue with the accrual system, and for income tax purposes, you continue with the cash system. So, adopting that analogy, I don't see any reason as to why a charitable institution which wants to prepare its accounts on accrual basis can't determine its income even for section 11(1) under the cash basis, so that they can say that everything is aligned. As far as I am concerned, Income Tax Act is concerned, my income is on cash basis, my application is also on cash basis, so that there is no dichotomy. It's possible according to me.
So coming to the practical thing, when I go and prepare the 10B or 10BB, whichever is applicable depending on which regime I fall under, for 10B and 10BB, then I should prepare a separate account totally on cash basis, income, expenditure, and balance sheet, and then accordingly
get them audited also.
Obviously, 10B and 10BB presupposes that will be audited. So the accounts for the purpose of 10B and 10BB will be a separate account on cash basis where both income and expenditure are accounted for, income and the application are accounted for cash basis, and then carry forward from there to the ITR 7.
Correct.
I think that is the only way to go about it.
That's right. You have to prepare a separate set of cash basis and then get them audited, and then use those figures in the return and upload this audited balance sheet.
Yes, because as soon as they upload my accounts on in where income is on mercantile basis, the assessing
then
officer,
there will be a problem.
We know, the department, as we know, will say there is no provision in the act to treat the income on the cash basis. I'll treat the income on accrual basis and application on cash basis.
There will be another major issue would be that the moment you put your excess of income or expenditure in the particular column, that amount is picked automatically for the computation.
Yes,
so
yes, sir. That's what I'm saying. Yes, sir. This is going to be creating a lot of major practical issues for
therefore,
the
you prepare a separate balance financial statements on cash basis and put that figures.
Thank you.
Nothing wrong with that, according to me. Thank you. Yeah, we'll go to the next. So now we'll come to the various conditions which are there in section 11. Section 12A have been amended. Okay, one is that, as I was telling you, that earlier condition was that you should get your books of account audited. It was understood that every charitable trust institution must maintain books of account and get their books of account audited. But there was no specific provision for maintenance of book. For instance, unlike section 44 AA, which requires you to maintain books of account, and then section 44AB, which requires you to get those books of account audited. Here it only talked about audit. It did not talk about maintenance of books. Possibly some trust took an argument that I am not maintaining books of account. I am just estimating my income or expenditure. These are based on my bank accounts. I'm just giving you a compilation of my bank, and I prepare my income statement from that. And therefore, I'm not maintaining books of account, and therefore there is no requirement to get the accounts audited. And possibly they were getting away with it. And to possibly plug this loophole, now they have made it very clear that you should not only, first you should maintain books of account and get such books of account audited by a chartered accountant. I think this is fairly clear. There is not much of an issue on this. Next one, please. Now we'll come to a very important topic, which is with reference to the cancellation of a registration. You are aware that section 12AA3 and section 12AA4 permitted the Commissioner of Income Tax, who has granted the registration, to cancel the registration under certain specified circumstances. Okay. Now there is that section 12AA5 says that nothing contained in that provision shall apply with effect from 1/4/2021. So therefore 12AA goes. So in its place, we had section 12AB, which we saw when the TOLA was introduced. Section 12AB, subsection 4 and subsection 5 dealt with cancellation of registration. It was not a very elaborate section, etc. It had some issues. So, but now the section 12AB 4 and 5 are now proposed to be amended comprehensively. And similarly, the 15th proviso to section 1023C, which dealt with the cancellation of registration, is also proposed to be amended. Both are aligned. There is no problem. There's not much of a difference on that. Now, under what circumstances the commissioner can, let's say, cancel a registration? They say a commissioner can cancel the registration if there is a specified violation. Now, the specified violation has been defined. What does it mean? It says income is applied for the purposes other than the objects of the trust or institution. So if there is a total misapplication of income, which is not for the purpose of the objects of the trust, then the commissioner can cancel the registration. Trust or institution has profit from business which is not incidental to the attainment of the objects of the separate books or not maintained. This is something similar to section 11(4)(a). That is, if you are carrying on a business and if that business is not incidental to the attainment of the objects, and if you do not maintain separate books of account in respect of such incidental business, the exemption under section 11 will not be available. So if you violate certain conditions are like section 11(4)(a), then the commissioner can cancel the registration. Next one, please. Income or property has been applied for private religious purposes or application of income for the benefit of a particular religious community. Now, when you look at these two are not there in 1023C. There's a difference. Because 1023C approval itself would say very clearly it is for a specific purpose like a educational institution or a hospital or a specified charitable trust. So therefore, we don't have any issue of a private religious purpose or for a particular religious community. So based on that, now this is applicable only for a charitable institution. So if any of the trust is doing this, then the registration will be cancelled. Only as a matter of interest, we have note that today, section 13(1)(b) says that if you apply the income for any benefit of particular religious community, the exemption under section 11 will not be given. But that was not a reason for cancellation. Now they have made it a reason for cancellation. Then activities are carried out or not genuine or not being carried out in accordance with all or any of the conditions subject to it is registered. Now, this is a very important requirement. You must see that not only you say that activities are being carried out are genuine, but they have to be carried out in accordance with the all or any kind of a subject is registered. That means whatever the conditions specified in the registration letter by the DIT exemption or the Principal Commissioner of Income Tax, as the case may be, those conditions must be satisfied. I will come to this, whether certain conditions which are mentioned in that should be or if they are violated, what happens, whether they are so serious as to warrant a cancellation of registration. Then violation of any other law and the authority under that statute has held so, and such order or directions, etc., are not disputed or has been finality. Suppose you are an educational institution, as I was telling, that if AICT or the Medical Council of India or any other statutory body which has control over your activities says that you have violated certain provisions of those statute, and the order stating that you have violated and possibly taking some punitive action is, if it is not disputed or if it has attained finality, then what happens is that the commissioner gets a power to cancel your registration. Next one, please. Now, how does the commissioner go about getting these kind of information so that he can initiate steps to cancel the registration? The first is, if the commissioner on his own gets some information that these specified violations have taken place or have been committed by a charitable trust, then on his own motion or suo moto, he can issue a notice for cancellation. Second, 143(3), there is a second proviso which says that the assessing officer can make a reference to the commissioner to cancel the registration if he, during the course of the assessment, if he notices that, and until the commissioner takes a decision by passing an order in writing, the assessment has to be kept in abeyance. He cannot straight away deny the exemption. So earlier we had this same thing as a first proviso, okay, where under section 143(3), which was there, but the first proviso did not cover the section 11 institutions. Now the second proviso has been introduced where say that all these things and section 11 institutions are also covered that. So therefore, whenever a 1023C institution or section 11 institution commits a violation and during the course of the assessment proceedings, the AO comes, notices it, he has to make a reference to the commissioner, and he can pass the assessment order only after receipt of the order from the commissioner under section 12AB4 or the 15th proviso in the section 1023C. Then where the case has been selected in accordance with the risk management system of the board to say that they notice that there are certain violations done by this institution on some information they have received, and they can flag those institutions, and the commissioner having jurisdiction over those institutions can, on the basis of such flagging in the risk management system, can take action for cancellation. Now, what is the procedure for cancellation? We'll go to the next round. Next slide. No, just go there. Yeah. The procedure for cancellation to be followed by the commissioner is he can call for documents or information from the trust itself or make such inquiry as he thinks necessary. This inquiry which we are talking about, it is not necessary only from the trust. He can make an inquiry even with reference to a third party to satisfy himself whether there is a specified violation or not. Okay. Then once he is satisfied, that there is a specified violation, then he has to issue a notice. Next one, please. He has to issue what it says is that after that he has to cancel the registration if he is satisfied about the occurrence of specified violation, or pass an order refusing to cancel registration if he is satisfied the specified violation has not occurred. Then forward a copy of the assessing officer, and the commissioner has to give an opportunity of being heard to the trust before passing an order cancelling the registration. So it is very important note here that there is a notice issued only in respect of calling for documents or information. There is no notice issued for a formal notice saying that I propose to cancel your registration. There is no requirement of issue a notice. It is enough if he gives you an opportunity of being heard to do that. This is almost something like what the Supreme Court said with reference to section 263 in Amitabh Bachchan's case. Next slide, please. Okay, so that we will see that later. Then the next point is that the order has been passed before the expiry of 6 months from the end of the quarter, in which the first notice is issued calling for documentation or information or for making inquiry. So this would be with reference to the quarter. The quarter would be January, March, April, June, July, September, and October, December. It is, according to me, it is not something which is like 90 days or 3 months from that. For instance, there won't be a quarter like February, April. The quarter, in my opinion, is the normal quarter as understood in the Gregorian calendar. That will be Jan, March, April, June, July, September, and October to December. Next one, please. Now let us look at what are the issues that arise. The first issue is you look at the language between the 15th proviso and section 12AB4. In the 15th proviso, they don't use the expression a provisional approval. They only say the approval granted under 1023C. As we saw in the TOLA amendment, where the first proviso and second proviso to section 1023C was amended to say that to provide for a provisional registration under certain circumstances. So therefore, if a provisional registration is given, or not registration, I would say use the expression approval. If a provisional approval is given under section 1023C, then as per the 15th proviso, the commissioner cannot register, cancel that registration. Possibly, I'm thinking out loud, he has to exercise his power of cancellation when the provisional registration is sought to be converted into the final registration. Because we saw that when he converts the provisional registration, application is made for conversion of a provisional registration to final registration, he can either grant final registration or cancel the registration. So he can do it at that stage, or in some cases he may have to grant the final approval and then cancel it. But it is more likely the first situation will arise because at some point of time, the institution has to make an application for converting the provisional approval into a final approval. So he has to, at that point of time, the commissioner can exercise the power, all the procedures can be followed, and then the registration the approval can be cancelled. But when it comes to section 11 institutions, section 12AB4 uses the expression approved, registered, or provisionally registered. So both are covered under that. So this language difference, I'm not able to understand as to why it is not there, whether it is a legislative slip-up, a drafting error, or is there any specific purpose behind it, because the memorandum explaining the bill does not talk about this. they almost repeat the language of section and then say that they are only done for the purpose of better management and control. Okay. Then, as I said, there is no requirement that a formal show cause notice should be issued. It is enough if an opportunity of being heard is given. Next slide, please. So we are talking about what the Supreme Court judgment in Amitabh Bachchan's case. I have one, slightly on off track. I'm really not able to understand this decision of the Supreme Court in Amitabh Bachchan. How can an opportunity of being heard be given without issuing a show cause notice? Even if he says that I propose to cancel your, revise your order under section 263, please come and meet me. If he tells you something orally, is it sufficient when during a personal hearing? Is it not necessary that whenever a government officer wants to speak, he speaks only in writing? So therefore, he speaks through files. He speaks by giving notices in writing. So therefore, with due respect to the Supreme Court, to say that section 263 does not require a formal issue of notice, and it is enough if you give an opportunity of being heard, because the section does not use the expression of issuing a notice, is not right. Because that issuing a notice under section 263 is almost a sine qua non for exercise of jurisdiction. But anyway, that's the law of the land. That's what the Supreme Court has said. So similar principle will apply here also. There is no requirement for a formal show cause notice from the commissioner before cancelling your registration. He can adopt any procedure he wants for that, but subject to a proper opportunity being given. Then the cancellation is effective. This is a very important point. This is the next one. The cancellation is effective from the year in which a specified violation is noticed and subsequent years. Okay. So now let us say, for the sake of argument, that a violation has taken place in financial year 23-24. So then the commissioner will cancel the registration from the financial year 23-24, that is assessment year 24-25, and all subsequent years. Okay, so therefore, for all subsequent years, you will not get the exemption under those, either under section 1023C or under section 11. Next slide, please. Now, look at the issue. It is possible that by the time the commissioner passes an order, especially in a case where it is a suo motu inquiry and then cancellation, or when the cancellation happens on the basis of a case selected in accordance with the risk management strategy adopted by the board. So in both these cases, there is a possibility that for any of the years for which the cancellation would become effective, the assessment has already been completed, giving the exemption under relevant sections. So let us assume that we'll take this. I will explain to you through an example that is there in the next slide. So the only way the commissioner can do something on that is invoke his powers under section 263 and say that order is erroneous insofar it is prejudicial to the interests of the revenue, subject to limitation available under section 263 and all other safeguards. Possibly he can revise that order. But if 263 limitation has expired, or if he chooses not to do so, the sections which otherwise permit a variation of a completed assessment, like section 148 reassessment, rectification 154, automatic amendments under section 155, those sections as they stand today will not come to the rescue of the commissioner or the department to disturb those assessments. Then the important point to note in respect of this is another issue is that there's a time limit only for passing the order. There is no time limit for issue of the notice calling for documents or information or making inquiry. We saw one of the suo motu inquiries he can make, at what point of time he can do, whether he has to do it within X number of years from that. There is nothing of that sort. The time limit is only for passing of the order, which is after the first of the notices which has been issued. 6 months from the first of the notice which has been issued. Next one, please. No, there is one slide I think which is missed on the, look at the, I had given an example of that issue. This, after this, what is the next slide?
Yes, sir. Just a minute. So this
Okay. Yeah, I think I just got jumbled up.
one. Okay. Yeah. Okay.
Yeah, sorry.
I'll stay on this slide, sir. I'll stay on this slide.
Yeah, you please stay on this slide.
Yeah.
Yeah, in the example I'm talking about is that when the commissioner, in the intervening years, when something happens and the assessment has been completed, how does those assessments get modified because of cancellation? Whether there is a procedure available under the Act, whether it is permissible under the existing provisions, what I explained. Now I will demonstrate that with an example. Now let us assume that the violation is noticed in financial year 22-23. Okay. Commissioner passes the cancellation order in financial year 24-25. Okay. No, this is not the one. This is a different one. No, you please go back. Go back to the next one. This is, I think I have not given that. Kindly go back.
Sir, let me just go down 1 minute.
No, it is not there. It is not there.
Oh.
I think that there's no example. You go back
Okay.
to slide 48. Okay, what we are saying is that in respect of those years for which there is no section 148, 154, 155 will not apply, and therefore the department is remediless as to how. So this can be addressed by introducing a section in 155, a provision in section 155 saying that whenever a commissioner passes an order cancelling the registration, if any assessment had been completed and the cancellation becomes effective even for those assessments, then the exemption given under section 1023C or section 11 can be withdrawn, and accordingly it can be done. Next slide, please. The other question is, as I was saying, is that the limitation with reference to the first notice. So it implies that the commissioner can make issue any number of notices to the assessee calling for information. It is not enough. I mean, you can't say that he has to issue notice only once, and he has to mention whatever he wants in that first notice, and he can't issue subsequent notices. He can ask for, he can issue any number of notices and ask for whatever relevant information he wants before he takes action onto that. As I was telling you, the limitation is with reference only to passing of the order. The limitation is not with reference to the calling for information. Now, the next question would be, if the limitation, he had issued the first notice, he started the inquiry, but for some reason, the order was not passed within limitation. Then what happens? Can the commissioner say, all right, I will close that file. I will start a fresh proceeding. I will start again another inquiry. I'll start again calling for the same information from the very same material. I will ask for it, and therefore my limitation gets expired. In my view, I mean, this is my personal view, the answer is no, because permitting such a course of action would amount to abuse of law. You are completely defeating the purpose of law, which says that you have to pass an order within limitation. So therefore, my point is that if something has lapsed because of the commissioner is not able to pass the order because of expiry of the limitation, he cannot start a fresh inquiry to get over that limitation. It is possible that in future he may get some other fresh material based on which he wants to start the inquiry. Then it's a different matter. But on the same material, he cannot start an inquiry again, or he cannot ask for the same information from you once again, all over, and to say that my fresh limitation will start from that date, which is not right. Then the next point is that what happens if your registration is cancelled? You may take it up in appeal, etc. That's a different, whatever remedial action you want to take is fine. That is absolutely no problem on that. But what happens if, can you make an application, a fresh application under 12A1C AC6? We saw that in any other case, the trust can make an application for registration on based on which the provisional registration will be granted. So there is nothing in the Act which says that you cannot do that. There is no specific provision saying prohibiting you from saying that once a registration is cancelled, you cannot make a fresh application for registration. Just to draw a parallel, we had Section Settlement Commission provisions which says very clearly that once the order is passed under Section 245D4 in the case of a person, that person cannot make another application under Section 245C later for any other assessment years. Okay, there is no such prohibition here saying that if a commissioner cancels your registration, you will not. In fact, in practice, we had made an application for a fresh registration after the registration was cancelled, and the department has given us the provisional registration. Of course, the original registration cancellation is in appeal. That's a different matter. So therefore, you can make an application. Next slide, please. But there could be a problem. For some years, you may not be able to get the exemption. This I will be able to explain to you by way of an example. Now, let us say that the violation is not done if a finance or violation happened in the financial year 22-23. Commissioner passes the cancellation order in financial year 24-25. Then once it receives the order, possibly the trust can make an application for first registration in the financial year 24-25. But as we saw earlier, the registration will be effective only from financial year 25-26 because of the requirement that the application for a fresh registration will be has to be made 1 month prior to the commencement of the relevant previous year. So therefore, in this case, if you had wanted for 24-25 financial year, you should have made your application sometime in February 2024. You have not made that because at that time there was no cancellation of registration. It happened only in 24-25. So even though you make the application in financial year 24-25, your provisional registration will be effective only from financial year 25-26. So what happens for these years, that is from the assessment year 23-24, relevant to the assessment year 22-23 to assessment year 25-26, you will not get the benefit. 23-24 is not an issue because that is a violation has taken place in that year. But 24-25 and 25-26, maybe those years, there is absolutely no violation. You have carried out your activities exactly in accordance with the trust and in completely satisfying all the provisions of the Income Tax Act. But still, the cancellation is for the year in which the violation takes place and subsequent years. These are the subsequent years, 24-25 and 25-26. You will not get the benefit. You will get the benefit only from assessment year 26-27. Next slide, please. Okay. Before going into the amendment to section 13(1)(c) and 13(1)(d), are there any questions on cancellation? Yes, sir.
Rakeshji, I think you can speak. Yes, Rakeshji, now please try.
Now,
can
am
hear
I
you.
audible?
We can hear you now, Rakesh.
Yeah. My question is suo motu going for a change from 1023 to 12A. There is a 1023 6A approval was taken under the new e-registration protocol, which is valid for 5 years from assessment year 22-23 to 26-27. Now, if the institution wants to shift to 12A because in the finance bill, there is no difference between 12A and 1023C. In fact, 1023C has got an additional condition of philanthropic purposes for a medical institution, which Section 11 doesn't have. So in that view, if the institution wants to shift under 12A, will it be deemed to be first a cancellation of the registration? Number one.
See, so that you say that the 115 TD is applies. Okay.
Yes, right. If a suo moto now, as of date, before this new regime, the trust had both 12A and 1023C, but it had never applied. The income was assessed and return was filed under 1023C only.
Yeah, because now the explanation below section 11.7 explanation says very clearly that if you had applied for, if you had obtained the registration and approval under 1023C, then the registration granted under here will automatically get cancelled.
Automatically stand cancelled. So as soon as it applied and it got the new e-registration.
Basically, the question is, this question is with reference to 115 TD, because the
so my first
what will happen is, see, if the registration is cancelled, okay, or the approval under section 23C is withdrawn for any reason, so far section 115 TD was not applicable. Okay, to section 10, yeah, 1023. But now there is a proposal in the finance bill to amend section 115 TD to include the 1023C institutions also under its rigor. So the problem would be that, technically speaking, very on a strict interpretation of 115 TD, there is a conversion of the institution for the very simple reason that there is its registration under section 1023C is cancelled. Okay, or rather the approval under section 23C is withdrawn for maybe at the request of the assessee, and it goes into 11. I can only answer this question on a general principle that section 115 TD would apply when there is a violation of the relevant sections of the Income Tax Act. It's a penal provision, because on 30% of the accrual income you have to pay tax. So one has to interpret that section 115 TD in a reasonable manner. And in a case where a 1023C approval is sought to be converted into a registration under section 11, under section 12A, etc., I feel that the provisions of section 115 TD may not be applicable. Of course, this is a very tricky issue. Incidentally, just as a matter of information, you know, in the case of the Andhra Pradesh State Pollution Control Board's case, the Andhra Pradesh High Court was dealing with a case where the Pollution Control Board, which was approved under section 1023C, wanted to go under section 1046. So for that purpose, they wanted to get their 1023C approval withdrawn. They made an application to the commissioner saying, please withdraw. But the commissioner said that the withdrawal is always at the instance of the department, not at the option of the assessee, and they refused. But the assessee went to the High Court, then the High Court said there is nothing like that, you can do that. See, in that year, there was no problem of 115 TD for that board, for a very simple reason, because the section 115 TD was not there in statute book, or even if it was there, it is section 1023C was not applicable. Okay, to section 115 TD did not cover section 1023C. But now, unless the interpretation suggested by me is found to be reasonable, but on a strict literal interpretation of section 115 TD, there is a conversion because the 1023C approval has been cancelled.
That's what my apprehension was. Until a clarification comes or it is settled on some judicial forum.
Therefore, I would only say this much, that unless there is a very compelling reason to do so, please don't do it. Let's not invite trouble.
Got it. Thank you, sir. Thank you very much. I appreciate it.
The next one is amendment is with reference to section 13(1)(c) and 13(1)(d). You are aware that section 13(1)(c) says that if any income or the asset or the property of the trust is applied for the benefit of the prohibited persons under section 13(3), then the exemption under section 11 is not applicable. There is a problem there, because earlier, if you look at the operative portion of section 13(1), it says nothing contained in section 11 or 12 shall apply if. Then it says if income is applied for the prohibited person's benefit, income or the asset is applied for that. So if certain portion of income which is applied to the benefit of the prohibited persons, whether the trust will lose its entire exemption under section 11 or whether only the proportionate income will be taxable and the balance will be subject to exemption. The department was of the view that the entire exemption is to be foregone. You won't get even 1 rupee exemption on this. But the decision of the Karnataka High Court in Father Muller's case, 363 ITR 230, held otherwise. It said that only the appropriate fraction of the income can be taxed, and you can't deny the exemption under section 11 in total. So this was the decision of the. So now the amendment is proposed in section 13(1)(c) and 13(1)(d), and also in the relevant proviso in section 1023(c) to say that only such part of income as is referred to in subclauses 1 and 2 at the it would be that is those with reference to 13(1)(c) and 13(1)(d) would be taxed. So at the end of section 13(1)(c), they will add this word, such part of income as is referred to in subclauses 1 and 2 of 13(1)(c). So whatever is the income which is specified in 13(1)(c) and 1(2), which are the benefit to the prohibited persons, only that portion of the income will lose the tax benefit, and the balance portion will be eligible for exemption. So the Father Muller's principle laid down by the Karnataka High Court has now been legislatively accepted, and the relevant amendments have been made. Next slide, please. But then, of course, this is something which does not arise only out of the finance bill. We always was wondering if an asset or a property of the trust is applied for the benefit of a prohibited person, how would you determine that portion of the income? Now, let us just say, for the sake of argument, I would say that a car is allowed to be used by the trustee for his personal purposes, or he uses it only for personal purpose. It is one thing to say that, okay, the relevant portion of the expenses will not be allowed as an application or as a normal revenue expenditure is a different thing. But that income has to be taxed. How do you do that? Can you say that? Can you impute certain notional income for that use and say that is the income proportion? No, it is not. So there are certain problems where, in a practical sense, it would be very difficult to determine the income which is relatable to a particular asset or property being used by the trustees. How do you determine that income? Because that income has to come from your books. It can't be notional, because only what is earned by you can be denied the exemption. Nothing can be added on the basis of a notional basis, saying that I will tax the income, I will impute income. That is not permissible. So if you are simply having a certain assets, this is a major problem, but that is not addressed by this Finance Bill 2022. There are no rules specified as to how to determine the appropriate portion of the income which will become taxable under section 13(1)(c) and 13(1)(d). Next issue, please. So on this Father Muller's principle and the amendment to section 13(1)(c) and 13(1)(d), if there are any questions, I will take them.
Sir, there are two questions. I'll just allow them to speak.
Yeah.
Mr. Lalit, I'll just allow him. Yeah. Mr. Lalit?
Hello.
Yeah. Mr. Lalit, yes, we can hear you. Yes.
No, my query was same, which has already been discussed.
Okay. Good. Done. Okay. Rakesh ji,
Can I? Hello.
yeah, yes, Rakesh ji, we can.
Sir, in this, the way the 21st proviso is worded, it says has been applied directly or indirectly for the benefit of any person referred to in so and so shall be deemed to be the income of such person of the previous year in which it is so applied. The way it is drafted, it seems here the person, such person, which is they have copied the same. I face this same issue under section 12, 13, and 11. The wording, it seems they are trying to say if where the income or part of the income or property of any fund or institution is applied or has been applied directly or indirectly for the benefit of any person shall be deemed to be the income of such person. So if I go for technically where the courts have said where the language is plain and simple and not supposed to read in anything, it says that it will be the income of the person for which it is applied. That means what they are trying to say, any such income received from a charitable trust, the benefit received will be the income of the person which is receiving the benefit. It is the language does not say as such, though we treat it as such. The language does not say it will be the income of the trust. It says it shall be the income of such person.
I understood your question, sir.
Such person means to for
I'll come
whom
to
the
that.
benefit.
I'll answer your question. See, just for the benefit of the others, I'll just paraphrase Mr. Rakesh's query. The proviso says that the 21st proviso to section 23 says that if there is a violation of section 10, 13(1)(c), 13(1)(d) read with section 13(3), such income or part of the income of the property shall, after taking into account the various provisions of the said section, shall be deemed to be the income of this such person of the previous year in which it is provided. Now, what is the meaning of the word such person? What does this such person refer to? It is the person in receipt of those benefits, like the trustees or the managers, etc., who are prohibited person under section 13(3), or does it refer to the institution? See, for this, what you have to do is you have to go back to section 1023(c). Let's take, for instance, one example. I'll just read section 1023(c). starts, the operative portion starts like this. Any income received by any person on behalf of. Okay. So if you read subsection 6, let us say, which is normal variant, it will be like this. Any income received by any person on behalf of any university or educational institution. So therefore, the exemption is given to the person in receipt of the income. Though in very common parlance or common thinking is that the educational institution's income is exempt. Technically and legally speaking, it is the person who is in receipt of the income of the university or educational institution. So therefore, it is that legal person, where maybe it a trust, maybe it's a section 13 company or a 2013 company, or any other form of charter income for non-profit organization. So the such person refers to here is the person who is in receipt of the income. That is the trustees or the managing committee or the organization which runs the school. So that is the person referred to in such person, and not, it is not treated as income of the person who is a trustee. by this proviso. So therefore, the point to be considered is, I do agree with Mr. Rakesh that even when I went through this for the first time, I got a bit confused, saying that this can, then I was looking at section 224. Just let's see whether in 224, whether this is treated as income. No, that is not treated as income under section 224. So therefore, the point is that the expression such income or part of income on such person is only refers to the institute organization which is in receipt of the income from the university or education, etc. But there will be somebody who will be owning that educational institution. That is the person referred to in this, and therefore it does not refer to the prohibited person under section 13(3), because you can't this proviso is totally meaningless, because you can't place that taxing of somebody else in a proviso to under section 1023C. If you wanted to do it, you should do it something by amending section 224, like in the case of directors of a company, if any perquisite is given to them, that is included in the definition of income. So similar definition should be made in section 224, not in 1023C. Therefore, though there is a problem in understanding this, the intention is very clear that it will tax only the trust, which is running the institution.
Thank you.
Am I clear, sir?
Yeah. Thank you very much, sir. Clear.
Okay, sir. Next. The next proposal in the finance bill is the amendment to section 13 and section 1311. That is the 22nd, and also similar 22nd proviso to section 1023C is proposed to be added. What it says is that under certain circumstances, the income of the trust shall be treated as specified income, and they will be computed in a special manner. Can you note, this is nothing to do with the tax rate or anything like that. It's only because that portion of income which is not exempt, okay, then there will be an issue saying that this portion of the income will be taxed. How will you compute that income? It may be taxed under general provisions of the Act only, but how will you compute that income is what is provided in section 1310 and 1311. If a trust carries on any business and it is hit by the proviso to section 2 subsection 15, thereby attracting the disallowance under section exemption under section 13(8) or the disallowance under section 13(8), if it violates the condition of not maintaining books of accounts or not getting its accounts audited, or if it does not file, next slide please, does not file the return within the time allowed under section 139(4)(a) or 139(4)(c) is concerned, that income would be computed in the manner laid down in section 1310 and 1311, and then it shall be taxed accordingly, according to normal slab rates. We'll go to that. Next one. Next slide. What does it say? It says income chargeable to tax shall be determined or shall be computed after allowing the deductions. Expenditure other than capital expenditure incurred in India for the objects of the trust or institution. So what they are saying is, if there is a revenue expenditure which is in the nature of application of income, that amount would be deducted from this income. Next, to claim the revenue expenditure, the following conditions should be satisfied. The expenditure should not be incurred out of the corpus, okay, standing to the credit of the immediately preceding previous year. Next. Next slide. It is not out of any loan or borrowings. Depreciation in respect of the assets which have been claimed as application of income will not be allowed as a deduction, and such expenditure should not be in the form of any contribution or donation to any other person. And while computing this income, section 40A1A, section 40A3 and 40A3A will be applicable in computing the income. Similar amendments have been made to section 1023C by adding the 22nd proviso. So what section 1310 and 1311 would say is that once there is any of these three things happens, that you are carrying on a business and which is hit by the proviso to section 215, or you are not maintained the books of accounts or got the such books of accounts audited, or if the return is not filed within the time specified in section 139(4)A or 139(4)C, then that portion of the income will be carved out and taxed. It will not get exemption under section 11. Okay. Now, so this is what it says. Now, what are the issues on this? Next slide, please. See, it only says that if you permit me to read the relevant provision of section 1310 from the bill, it says like this: where the provisions of subsection 8 are applicable to any trust or institution, or it violates the conditions specified in clause B or 12BA of section 12A1, its income chargeable to tax shall be computed after allowing the deduction for the expenditure. So how it only says is income chargeable to tax after allowing these expenses. So what is the starting point for the income computation? Fine, no doubt I get these revenue expenditure application as a deduction, no doubt about that, subject to the conditions. But what is the starting point? Whether it is a gross revenue or only the revenue and out of that the revenue expenditure, which is the nature of application of income, would be allowed, or I would compute the income under the normal provisions of the Act, and after deducting all the expenses, I would claim the deduction in respect of the revenue expenditure, which is the nature of application, which is not deducted while computing my net income. We discussed this in the last class also, but I'll just give you one more example. The business is being carried on. So when you carry on a business, there are any number of expenses which are incurred in the course of carrying on the business, which are allowable under section 29 to 43C. So when those expenses you deduct subject to that, and then you claim, you arrive at a net figure, and from that you claim certain revenue expenditure, which is the nature of application and which is also not incurred for the purpose of carrying on the business, then you claim that as a separate one, and then the balance amount will be taxed as the income. Okay, so now there are these section is very silent on this. It's not very clear from the wordings of there, and we also don't know what is the purpose behind this. Is it that they are saying that if these violations take place, the entire income will not be exempt under section 11, then only the income chargeable to tax comes into picture. So if you carry on a proviso, I mean a business which is hit by the proviso, your purpose is not charitable at all. So the question of claiming exemption under section 11 would not arise. Then the second point is, if you do not file the return in time, what is in the return you claim? You claim the entire income as exempt, subject to the conditions. Since you are not filed the return, the entire income will become taxable. Similarly, if you look at the failure to get the maintained books of account or get the accounts audited, this is also with reference to the entire income. So therefore, in my opinion, if you are looking at section 1310 and the 22nd proviso to 1023C, if any of these things happen, the whole income becomes taxable. If the whole income becomes taxable, section 1310 gives a special mode of computation. This is more in the nature of a benefit to the trust rather than a punitive provision. Because normally what would have happened, let us assume that if you are not entitled to exemption under section 11 for whatever reason, your income has to be computed in the manner laid down in the Act, because the total income has to be computed in the manner laid down in the Act in accordance with Chapter 4. Okay, so when you do that, you will get one figure. But this income which is computed under Chapter 4 does not permit you to claim deduction which is in the nature of revenue expenditure applied for the charitable trust, because it is not for the purpose of business, or it cannot, it may be, if your income is computed under Section 22, it is not a permissible deduction under Section 24. If your income is computed under Section 56, this is not coming under Section 57. Similarly, if any other capital gains is there, this is also not a permissible. Therefore, the revenue application which happened by a charitable trust, they say, all right, in respect of such revenue application, I would give you the benefit, an extra benefit of allowing the such revenue application in addition to the other expenses which are to be necessarily allowed as per the relevant provisions of the Act. So this is what my view is. Can we just go to the next slide, please? Because if you're going to tax me on the gross revenue, it's an absurd situation. I may run a business where the business sales turnover may be in some 10 crores or 15 crores and say, I will not allow any expenses except the revenue application. And the department would say that whatever you have incurred for the purpose of business is not application towards the objects of the trust. They are all expenses incurred for the purpose of carrying on the business, and therefore this will not be allowed under the revenue stream on this under Section 1310. So therefore, and also taking into account the normal meaning of the word income, it has to be necessarily referred to the net income and not the gross revenue. Next one, please. Okay, this is what I had explained this. Next slide. One more thing which I have not put there, which you can also think is, if you see this one of the conditions which says is that the amounts under Section 40A1A, I mean the Sections 40A1A, 40A3 and 40A3A would apply while computing this such income. Okay. Now the question is whether this explanation would apply only to the revenue expenditure in the nature of application. That is, they would say that if you are incurring revenue expenditure, if tax had to be deducted source, have a deducted source. If it is so, then we will allow you that application. But if you are not deducted tax at source on such revenue expenditure which is to be treated as application, I will not allow it. Or this explanation only says for the purpose of determining the amount of expenditure under this subsection, the provisions of section etc. are applicable. So whether it applies to the entire income, all the expenditure which is required to be allowed is an issue, but prima facie this explanation only clarifies that in allowing the revenue application, revenue expenditure as an application of income, you have to satisfy that it is not disallowable under 40A1A or under Section 40A3 or 3A of the Act. I don't think it applies to the expenditure portion which is normally deducted from the gross revenue, because that's already covered by the respective sections while computing the income. I think we have to go one slide up. The other view that it is the gross income which needs to be taxed, and from that you only get the revenue expenditure application as a deduction, is by Section 1311. The Section 13 says that while computing income under the no deduction in respect of any expenditure or allowance or set off of any loss shall be allowed to the assessee under any other provision of this Act. But this has to, according to us, in our discussion, we said that this Section 1311 is a overkill. It is because this kind of prohibition they are putting it in every time when they make a section which they want to carve out from the general provisions. So therefore, this has to be read along with the main Section 1310, and on a general principle, the net income is to be computed as per the provisions of the Act. From that, you have to claim the revenue application and then balance would be taxed. Then one of the conditions is that such expenditure revenue application should not be out of corpus fund. So how do you prove that it is out of corpus fund? See, normally what happens is that even a mere entry in the books, keeping certain amount as a corpus fund is sufficient. To disclose that in the balance sheet as a particular fund is sufficient. It need not be specifically funded by an investment. It can be along with your general bank account. There is no harm in that. So how do you prove that it is not spent out of corpus? The only way we can do that is by preparing a normal cash flow statement. Kindly go to the next slide. So you prepare a cash flow statement and relying on the principles laid down by the Supreme Court in Reliance Industries and as well as the South Indian Bank Limited with reference to section 14A, you can say that the expenditure revenue application has come out of your income and not out of corpus. Okay. And that can be proved by a cash flow statement to show that the cash generated from the income is sufficient to allow this revenue expenditure application, though it might have gone from one single bank account. Your corpus amount, your regular income, everything is kept in one bank account. Let us say, just for the sake of argument, it does not matter. The department cannot say that every fund has flown into one bank account and you issue checks from that account and therefore it is there. Yeah. Yes, sir. Mr. Lalit wants to raise an issue.
Thank you, sir. Sir, my query is regarding that there is one provision which was brought into Act by Finance Act 2021 that a separate designated bank account will be maintained for the corpus fund, and
correct.
whatever corpus donation is received shall be kept invested in the mode specified under section 11(5). So I think
correct. Correct. So if you are keeping that, I'm wrong. I stand corrected. I agree with you.
Sir, there is one query here. I have one query that the point is that this provision is effective from 1st April 21. Now the point is that what about the opening corpus balance which is showing in balance sheet, the funds which have been already received, which have been already utilized, and there is some balance. So would be required to transfer that fund into a separate designated bank account, or the corpus donation which was received during the 21-22.
Let me just see that 11(1)(d).
Yes, sir. This is practical query, sir.
Yeah, I understand. It only says 11(1)(d) says income from in the form of voluntary contributions made with a provincial, they shall form part of the corpus of the trust or institution, subject to the condition that such voluntary contributions are invested or deposited in one or more of the forms or modes specified in subsection 5. See, what I am looking at is that this section 11(1)(d) you have to apply for each assessment year separately. So therefore, since this particular amendment is effective from the assessment year 22-23, only in respect of the corpus donation received on or after 1/4/2021, you have to satisfy these conditions. The earlier corpus conditions, because already you had a vested right of claiming the exemption. That vested right cannot be taken away unless there is a specific provision. They should have made a specific provision saying that in case of any corpus fund is not specifically funded like this, then you have to do it within a particular time. See, for instance, if you are looking at the investments, 13(1)(d) prohibited investments, because when the section was brought, already a lot of trusts had investments in the non-11(5) modes. Then the sections, the statute gave them specific time limit to convert those things, saying that you do it within a particular time. So therefore, since the similar provision is not there in 11(1)(d), my understanding is that it will apply only in respect of assessment year 22-23 onwards and not for the earlier corpus.
Agree, sir. Sir, one more point. Can we use the corpus fund for the purchase of acquisition of movable property, movable property, which
See,
will be
the corpus fund is to be used for the purpose for which the amount was received. See, if the donor says there's a corpus fund and says that use it for building, you can use it only for building because otherwise it will be a breach of trust.
right?
So it does
Agree,
not
sir.
depend on the, this one, it depends on the intention of the and the direction of the donor.
But sir, sometimes this direction is silent. The direction is just
That's what
that
I
I
said.
am.
If it is silent, then
Yes, sir.
you can use it for the purpose of area capital expenditure. It should not be an issue.
Should not be. But the provision says that you need to keep invested in mode specified in 11.5.
No,
And I
and you are
think-
talking about utilization. You can withdraw the money. It is not necessary that you should keep it only. For instance, the Karnataka High Court said that if a person gives a donation for a building fund, that is corpus. Obviously, when he gives a donation for building fund, you have to withdraw that money and use it for construction of building.
Correct.
Corpus does not mean it cannot get depleted by its permitted use.
Correct.
See, corporate is not something where you say, okay, I'm going to keep it in an I'm going to invest somewhere and I'll spend only the income portion. That is a
No,
normal
my-
understanding. But for the purpose of Income Tax Act, corpus can even be a specific purpose where you can remove it.
Agree, sir. My point is, sir, that there is a silent about the direction. There is no direction regarding the corpus donation. It is just received as a corpus donation, and the provision requires that corpus donation should be invested in mode specified under section 11.5, and 11.5 does not cover movable property of the institution. So can I say that can I acquire the movable property, not immovable, movable
So my
property?
point is
by
this.
utilizing-
This amount, until it is spent, has to be kept in an investment mode. If
Right.
you are going to spend the money and if you are permitted to do so without any trust being breached, you need not keep that money in 11.5. You can spend it from the 11.5 investment from the bank account, issue a check, and then do that. No problem, sir.
You mean to say that we can say like unutilized money should be kept
That's all.
invested?
Everything is
Right.
only unutilized.
Okay, sir. Thank you, sir. Appreciate
Yeah,
it.
I think there was one more person who was raised his hand. Is there a question by Bharat? By any other person?
Sir, just a minute. Yes, there was one person who raised his hand. Sharma ji is there, so I will allow him to speak. Sharma ji, good evening.
Yeah, good evening.
Good evening,
sir.
sir.
That just now that Mr. Lalit, I think, raised it, is that corpus donation to be in the designated bank account. So it need not be the new bank account. It can be in the existing bank account. There can be a separate earmarked FD.
But what it says is, I'll just read the relevant provision once again,
Yes.
if you don't mind.
Yes, sir.
Subject to condition that such voluntary contributions or invested or deposited in one or more forms or modes specified in subsection. Okay, now, as you said rightly, even the savings bank account of the trust or the current account of the trust is a bank account which is specified under section 11.5. So therefore, the corpus account can go into the general bank account of the institution or the trust, and then all you have to do in accounts to show is that it has not been spent for a prohibited purpose.
Right. So secondly, this 10-11, you said first compute the income and then revenue application. Will you please elaborate? When this revenue application also will be all these expenses only what you have claimed?
Sir, that's what I said. No, you remember, sir, when in the last meeting also we had a discussion on this point, and you raised a very valid point that in the case of a certain trust, institutions, etc., many of the revenue expenditure may be in the nature of application.
Yeah.
Okay. Then I was only explaining, saying that let us assume a case of a business which is hit by proviso to 250 and therefore you lose the exemption. Okay. So in that case, in respect of the business income, only the income expenditure incurred for the purpose of carrying on business would be allowed in accordance with section 29 to 3043C. There might be certain application of income in the nature of revenue expenditure. For instance, I was telling you about the a medical institution, medical relief, running a hospital, and also running something which is not incidental to that. So in that case, when you're looking at a non-incidental business, then it will become a problem that income has been computed. When that income has been computed, and from that income, whatever is the revenue, this one will happen. This is one question. Or let us take a trust having objects of general public utility. That trust has not filed the return within the due date. So it loses the exemption for that year. So what it says is that you compute the income under normal heads. There might be certain expense. Let us assume for the sake of argument that only the source of income of the trust is the rental income. There is no other income for that, just for the sake of argument. Then this rental income you are going to compute under section 22. But there might be certain revenue application expenditure which will not be allowed under section 24. Because very specifically only the 30% this one, then while computing the annual letting value, the municipal tax paid and the interest paid on borrowing for repairs or construction. And other than this, you don't get anything else. So therefore, if you are making another application of revenue expenditure in respect of your objects of how you have conducted a camp where you have treated a lot of patients, or you have conducted a seminar explaining to them how to go about various things, etc. Then this is an application of income in the nature of revenue expenditure out of the rental income. Since this is not allowed under the section 24, you will claim it under section 1310.
Yes, sir. Very well explained, sir. Yes, thank you. Yes, sir. Thank you.
So, any other questions there?
No, sir. Sir, just a second. Yeah, Lalit, Mr. Lalit spoke. Yes, sir. We can
Sir,
proceed.
one thing we will, because it is now almost 7 o'clock, I have another at least need about half an hour. Can we just put a cap on the questions on this issue, if you don't mind?
Sure, sir. Sir, it's up to you to take questions, sir. I'll give you the liberty.
No,
sir.
the only thing is because I shy away from answering questions. That's because I think it's going to take a lot of time. So
Yes, sir.
therefore,
Yeah. Sir, leave it to you. We'll proceed. We'll complete what you
yeah,
have
in case time is there, I will take up those questions later.
Right.
Okay.
Right.
Maybe
Right,
we can restrict for each topic, we can restrict the questions to 1 or 2 subjects. Okay, fine.
Sure. Sure.
Next. Now, there are certain amendments which have been made only to 1023C. As I said earlier, this is with reference to align it with section 11 to 30. Okay. This is an ongoing process, as I explained in the beginning of. Kindly, I think Mr. Lalit has to mute himself.
Sorry.
Okay, thank you. So this amendment now takes place as per the various provisions to say align section 1023C almost fully with section 11. The only thing which is not aligned so far is that the benefit of the proviso under section 12A2, which says that if your exemption under section 11 has been denied only for the reason that you have not been registered under section 12A earlier. Now and subsequently for any subsequent year, if you get registration in respect of all pending assessments, you will get the deduction under section 11 subject to fulfillment of other conditions. Similarly, no reassessment proceedings will be taken place in respect of those years for which you are not registered if you have subsequently claimed got the registration. This is the similar provision is not there in 1023C. So regarding approval, this is one difference we noticed. There could be some other differences But as I was mentioning in the beginning, since there is not much of a difference between the two, why don't you merge both and make everything under section 11? Forget this 1023C, except to the extent of 1, 2, 3 up to AE, because those things are a different regime. They don't require any procedure or anything like that. That can be done. Next slide, please. Now, this I have explained. Now, the third proviso to section 1023C is now proposed to be amended in line with section 11.2. That is, when you want to accumulate the income because you have not spent 85% of the income for the purpose of the trust. Okay, fine. Mr. Lalit says that Corpus Trust, this one also is, there's a difference between 1023C and this. The Corpus Fund is not there in 1023C. Right. Now, the following conditions are to be satisfied. What are the conditions? You have to furnish a prescribed statement, which you have already seen. The period of accumulation shall not exceed 5 years. The accumulated income is to be invested only in the modes prescribed under 11.5. This is all exactly like 11.2. It is just a matter of, so we'll go to the next slide. Then the application form for accumulation has been filed within the limit specified in 139.1. Then it introduces explanation 4, which I've already discussed with earlier while discussing 11.3. So we will skip this particular portion because already I have discussed it earlier. Now, there is an amendment to 19th proviso, which is nothing but one small change. For the words prescribed authority, they are made as a principal commissioner or commissioner. So therefore, this has no practical significance. Then the 20th proviso has been provided to say that you must file a return under section 139.4C to claim the exemption under section 1023.45668. Next one. Then section 143.3 is now proposed to be amended to state that if the assessing officer is satisfied that 1023 institution or a trust registered under section 11 has committed a specified violation, he shall send a reference to the principal commissioner to withdraw the approval or registration as the case may be. And until he gets the approval from the commissioner or an order saying that the cancellation is not needed, or an order saying I'm cancelling the registration or the approval, until then he has to keep the assessment in abeyance. Section 153 explanation 1 has also been amended to exclude this period for computing the limitation. Next slide, please. Yeah, this also I've explained. I'm rushing through this because these are all not much of an issue, because I would like to discuss. There is 115 BBI and 271 AE penalty provision, which are more important. Next one. 115 TD, we have said that 1023C is also included now, but they have recast the entire section on a very detailed analysis. We find that there's hardly any difference between the unamended and the proposed amendment sections. The only difference is 1023C has been introduced in appropriate places and the language has been changed accordingly. Next one. Now this is important. 115 BBI says that there are a specified income will be taxed at 30%. See, you have to be very careful about this. You have too many specified incomes, too many specified violations. You have a specified violation which is which will lead to cancellation of registration. Then you have specified income under section 1310, which will be computed in a specified manner for the purpose of finding out the total income on which the trust or the institution has to pay tax. Then you have section 115 BBI, which also refers to certain specified institution, where it retains the exemption under section 11 in respect of the other income. But in respect of these incomes, which are carved out from the such income of the trust, they are taxed at 30%. So this is how you have to do that. Actually, I have prepared one small table which says what are the various things covered under specified violation or income under section 13, specified income for 1310 and specified income for this. There is hardly any overlap, but in some cases there might be certain overlap is possible, but we will not discuss it now because I have not given the table now. I'll send it to the CTC so that they can share it with the members. Except for a very one small issue, there is no overlap between specified violation and specified income under section 1310 and specified income under section 115 BBI by and large for all practical purposes. So with this in background, what section 115 BBI says, on specified income, you have to pay 30% of the tax. What are the specified income means? One is the accumulated income excess of 15% of the income where such amount is not allowed. That is section 11(2) accumulation is not allowed under any provision of the Act. Now this has to be contradistinction with 11(3). 11(3) is a case where earlier the accumulation was allowed under 11(2) and you have violated the conditions of accumulation. Then 11(3) comes into play. But this is a case where at the threshold itself, for whatever reason, section 11(2) is not allowed to you. So that income, which is otherwise going to be taxed, will be taxed at 30%. Okay. For instance, you have not filed the application under for accumulation within time. Your income is 100 rupees. You have spent 40 rupees. Balance, you have to spend totally 85. So another 45 rupees you want to accumulate. But this 45 you did not file the accumulation application within time. So then now what the law will do is, it take the income as 100 minus 15%, which is a standard deduction. On that, the balance is 85. You have applied 40. And the balance income of 45 will be taxed at 30%. This is one example of this particular accumulation not being allowed at the threshold itself. The next one, please. The amount which is treated as income under section 11(3), which I explained earlier, saying that when you violate section 11(2), under section 11(3), in the year of violation or in a specified previous year, it becomes the income. So that income will also be taxed at 30%. Okay. So the next one is income from investment which are not in the modes of under section 11(5). Suppose you have violated section 11(5), then any income from such modes will also be taxed at 30%. The next issue would be if any income being chargeable to tax because of section 13(1)(c) becomes applicable, then you will have a 30% income on that. The last one is 11(1)(c). See, 11(1)(c) says that any trust which applies the income outside India for the benefit of the persons outside India, then that application will not be allowed as a deduction. The application has to be in India only. So if certain portion which is applied outside India becomes taxable, then it will be at 30%. Now let us look at the issues. Next one, please. Bharat, next slide, please. Yeah. Now, what are the issues on 115 BBI? See, 115 BBI, if you look at that, it uses the expression any institution referred to in 1023C4, 5, 6, and 6A, or a trust or institution referred to in section 11. See, these are the crucial words in section 115 BBI. So the question is whether when it talks about an income, a trust referred to in section 11, if it is, should it be registered or unregistered? Whether in other cases, if an unregistered trust also will be subject to 30% tax in respect of these years. See, this can happen if you just go back to the earlier slide. See, what are the conditions under which this 115 BBA applies? Income accumulated under section 11.2, income accumulated under section 11.3, then income referred to in section 13.1C, 13.1D, application of income outside. So what could have happened is a trust which was registered earlier has become unregistered subsequently. Okay, and in all these violations, let us say, takes place after the trust has lost its registration. So in that case, can the department say that, listen, you were registered once, I gave you all these benefits under that section at that time, even though you are not registered today, I'm going to tax you under 115 BBI. I will not simply take it as income of the current year as per the, if those sections permit, then apply the normal rates. Is it permissible for the department to do that? We are of the opinion that it is not permissible to do so. Because if you look at section 1023C, 4, 5, and 6, 6A, the approval is inbuilt. Section 1024 says any income of a university or 1026, any university or educational institution which is approved by the principal commissioner today for the purpose of this section. So therefore, it is only the approved institutions which get exemption. Whereas section 11 only says that subject to section 60 to 63, income of a charitable trust which applies its income for the purpose of its objects of trust will be exempt subject to various other conditions. But the the trust referred to in section 11 is merely a trust. Whether it is registered or unregistered is a different proposition for the purpose of claiming exemption. But what is referred to is the trust. So therefore, if one looks at section 11, you will say whether the trust is registered earlier, whose registration is cancelled now, and then subsequently it becomes a unregistered trust and violation has taken place because of the earlier exemption given. Whether section 115 BBI applies is a very vexatious question according to me. But we are of the opinion that because you want to maintain parity between 1023C institutions and section 115, section 11 institutions, it is absolutely necessary that in order to apply section 115 BBI, in the year in which these violations take place, the trust should be registered under section 12AB and not simply an unregistered trust which will apply in the case of a trust whose registration has been cancelled. The next slide, please. Next slide. This is what I have explained on this. Now, there is another issue on 115 BBA. If you look at section 164(2), there is certain relevant portions of a charitable trust, which is whose income is taxed at the maximum marginal rate. And whereas section 115 BBA does not use the expression maximum marginal rate, it uses the expression, it says that it shall be taxed at 30%. Of course, the relevant provisions of the Finance Act says that it's going to say it will be increased by surcharge and cess, etc. Okay, subject to that. But 164(2) says that in respect of certain income, you will have to tax it at maximum marginal rate. So for instance, if you look at section 13(1)(c), it is covered by section 164(2), which is also covered by 115 BBI. Now today there is not much of a problem because the MMR is also 30% and 115 BBI also use the expression 30%. Let us assume a case that tomorrow the MMR is changed. Either it becomes more or it becomes less. It is likely to become less because the government feels that the rate of tax has been brought down. So from 30%, they may bring it down to 25%. Okay, now in respect of the income which either falls under 115 BBI or under 164(2), which is the rate you are going to apply? My view is that if there are two provisions covering the same matter, then the one which is beneficial to the assessee should be used, and therefore if 164(2) rates is less, then it should be 164(2). By chance, if the maximum margin rate is increased, then it will be 115 BBI. So this is how I look at it. So next slide, please. Next. This is what I said earlier. Next one. So before going to 271 AAE, are there any issues in 115 BBI?
Let me just see. So nothing as of now, sir. We can proceed.
Okay. I don't understand the question from can both be taxed. What does it mean? That is, you levy tax both under 115 BBI and 164(2). No, I don't think so. It has to be only under any one of the sections. Okay. Next, 271 AE is a penalty. These are very draconian provisions. Okay. What it says is that if you apply any income, not the asset, that's a very important one. If you apply any income for the benefit of any person referred to in section 13(3), and if the violation is noticed for the first time during the previous year, you are liable to pay 100% of the amount of income as penalty. You means the trust or the institution. And if there is a subsequent violation which is noticed, then it is 200%. Because this is subject to all the normal safeguards of giving you an opportunity of being heard before levying penalty, etc. Next slide, please. Now, what is the main? This is a problem where violation is noticed for the first time during the previous year. Does it refer to the previous in which the violation actually took place, or the previous in which noticed by the assessing officer during any proceeding under this act? Example. Now let us look at the example, because this violation has taken place in financial year 22-23. Assessment proceedings are for assessment during the assessment proceeding for 24-25, not 23-24. During the assessment proceeding for 24-25, taken up during the financial year 2025-26, the AO note there is a violation. Now, you can look at 2 years now. One is 2022-23, which is the year of violation. 2025-26, because that is the previous year in which the assessing officer notices there is a violation for 22-23. Because when he asked for certain information, he found out that you have violated this particular 13(1)(c) in 22-23 also, and therefore he notices that in the financial year 25-26. So whether will you levy penalty in the financial year 25-26 or with reference to 22-23? Because if you say that it is with reference to financial year 25-26, there is a problem. There is no violation in that year. It is violation only in the, the questions will take later. Okay, 22-23. Next slide. On a very detailed analysis of the section, we have come to the view that the penalty is with reference to the financial year 22-23. Why this becomes relevant is because if this is the first notice for penalty, first year in which it is noticed, it is 100%. If in subsequent years, if anything, any further violation is noticed, the penalty will become 200%. So that is why this issue becomes very important. Otherwise, this issue is immaterial. So because the rate of penalty for the subsequent violation is double the amount, we have to be very clear about this, in which year you are going to levy penalty. For instance, can I say that if it is 25, 26, because that is the year in which the AO notices. So that is the first year, I'll take 100%. If later, if something happens in another year, it may become the second violation. On the other hand, if 22, 23 is coming in this, is noticed, 22, 23 has happened. If next year in 23, 24, another violation is noticed, then it becomes a second violation, it becomes 200%. These kind of issues are there. But I think the reasonable view is to take the view the previous year in which the actual violation has taken place. That is the first year of violation, and then subsequent year this. Next one, please. So with this, I complete my presentation and my discussion. If there are any questions, I'll take them.
So there seem to be a few questions.
Yeah.
Can
Can you just read them if you don't mind?
Yes, sir. So first is, I think by Miss Aarti, if she is there, I can just allow her to speak, and then she can ask her question. Miss Aarti?
Hi, am I audible?
Yes, madam.
Yeah.
Yes.
Sir, I wanted to know, you mentioned that specified violation is noticed in year 1, it will be taxed at 100%. In year 2, if it is not, it will be taxed at 200%. But my question is, what if another new different specified violation is noticed in year 2? Then in that case, the new different specified violation, will it be taxed at 200% or 100%?
See, the point is, for the purpose of 271 AE, it is only one type of violation, that is section 13(1). Okay. So if you look at section 271 AE as it's now proposed, all it says is that, just give me a minute, I will take that particular section.
So because they have mentioned a couple of different
Yeah,
types
I'll
of
do that.
specified,
See,
right?
what it says is that if there is a violation of 13(1)(c), the first violation is 10%. Now, the question I understand is something like this. Let us say that there is a violation of, in the case of trustee A in 1 year, which the assessing officer notices, and he says, I am levying penalty at 100% of that. And before that, there is no violation. In the second year, trustee B is given the benefits, and therefore there is a violation that year. Is your question that whether the second year violation will be treated as a first violation because it is with reference to trustee B or not with reference to trustee A? Is that the question?
No, the question is with respect to a different violation. These both the types of violation are just with respect to separate.
No, because 271 AE applies only to section 13(1). That's what I'm saying. This is not,
Okay.
don't confuse it with specified violation, which is under section 12AB4. That is
Yes,
for
sir.
cancellation.
Okay,
So
sir.
as
Okay.
far as 271 AE is concerned, the only violation is 13(1)(c).
And
So
Sir,
therefore,
So my question
continuing
is
with the-
exactly what you said, whether it will be, if the benefit is given to person A in the first year and person B to the first year, whether the violation here means on a
I
global
think-
basis, or it means a particular specified person wise.
my view is it should be on a
I was
global
coming to
basis.
that.
It should be on a global basis, because it talks about section 13(1)(c), the violation under section 271 AE, section 271 AE, and therefore it does not matter whether it is trustee A or trustee B or something like that, and hence it is has to be done on the basis. You look at section 13(1). 13(1)(c) does not pick out the specified trustees by name A, B, C or something like that. It only talks about as a trustees as a class. So therefore, in my view, it will be global.
No, sir, not about the trustees also, the specified persons, so there's a list of specified person. That's not on a trustee.
No, that's what I'm saying.
Out of the-
The whole prohibited, I'll use the expression prohibited persons.
Right.
Whoever comes under section 13(3) as a prohibited person will be there.
So what we are saying, suppose in financial year 2021 or financial year 22-23, the violation took place, a benefit was passed to a specified person. After 3 years, next 3 years, no benefit was given. After 3 years, not to the trustee, a relative or another trustee, a benefit was given. So that after 3 years, when a different category of a specified person benefit was passed to a different category of specified person, since already in the past, in the once, a benefit was passed to a specified person, the second one to a different category of specified person being passed benefit, if it comes to notice, it will trigger off the 200%. Because then what we are saying, there is a violation of passing a benefit to a specified person which has occurred in the past and again occurred after 3 years. So there is a repetition of violation.
That's what I'm saying, because I'm looking at section 13.3 persons as one clause who are prohibited class.
Right.
Okay, I'm not looking at section 13.3 as individual subclause wise.
Right.
So since because of that, that's why I said that it is whether it's a manager, whether it's a trustee, whether it's an author of the trust, or whether a person who has a relative of such person, trustees, any of these persons, all these things are put in one basket and they are prohibited under as a prohibited person under section 13.3. And hence, in my view, section 271 AE has to be with reference to the global.
Right. So that only in once for the first time when it occurs after this clause comes into effect, it will be 100%. Subsequently, even after few gap of few years or whenever it happens, the triggering off will be 200%.
See, the only point is there can be, I mean, a very interesting issue. Since I don't know the answer, I didn't put it in the slide. See, one interesting issue is that because of an action in 1 year, okay, that benefit may flow to the trustees, the prohibited persons over multiple years. You get the point?
Yes, sir. Yes, sir. Definitely.
If that is the case, whether in the second year and third year, are you going to levy 100% or you're going to say 200%, or you say nothing is to be levied, because what happens is that the prohibition happened in the first year and this is an effect of that. I can't withdraw that during that period for whatever reason. So this is one thing since I am not able to clearly think through.
Sir, I was coming to that.
This.
I was coming to that only because the permutation combination coming from the reading of this 271 AE is infinite.
Yes.
And it can be interpreted in any way one wants. The way that it has been drafted, the charitable trust now has to do a very tightrope walking to see whether the 200% does not get triggered up.
Yes. In fact, I would say that you should be very careful that you don't violate 13.1c, 13.1d, because one day or other they may even bring in this violation to this. And the point is, even today for the specified violation for cancellation, there is one clause which says that application of income for a purpose other than charitable purpose. Okay. See, some officer may say that, listen, since you have applied this income for a prohibited person, it is other than the it's other than the objects of the trust, and therefore I'll cancel the registration. Of course, this is a very highly contentious issue. I will not discuss it now. So my suggestion would be that we should advise all our clients saying that for heaven's sake, don't ever get into this section 13.1c, 13.1d issues.
And so this is in addition, when it starts with a notwithstanding clause. So that means if I don't voluntarily report it, then the under-reporting, misreporting penalty is in addition to this. Because
yes,
the section starts with
it is notwithstanding without prejudice to other provisions of the chapter.
Under this chapter. So those penalties will stand plus this penalty.
270A penalty will be there.
Gosh. Okay, sir. Thank you very much.
Question: whether rent paid to trustee for building owned by trustee used by the trust as hostel would fall in this category of violation.
The rent, whatever rent you pay to a prohibited person in section 13(3) is not per se covered unless it is proved that it is exorbitant. As long as the rent is in accordance with the market rate, there is no violation of 13(1)(c).
Currently, for a trust which has not spent the amount accumulated under 11 subsection 2 within 5 years, but has spent that in the 6th year, there will be no taxation as the income gets applied in the 6th year. Has this changed?
Yes, 11(3) has been amended. That's what I said earlier. Now the tax will be in the year of violation or expiry of the 5-year period, and therefore that one extra 1 year which you had the window is not available now.
Right. Sir, Ashok Sharma ji had a question. I'll just allow him to speak.
Yeah, this further questions are on this 11.3. If this accumulation, this amendment is from 23-24. So is it accumulation made hereinafter or for past accumulation also? If in 23-24 5 year is getting over, whether it will apply?
See, basically what happens is that let us assume that if the 5th year is assessment year 22-23, okay, then you will have the benefit of the old section, because this new section will apply only to 23-24, and therefore you have to go for the 6th year also, you can go. But assuming a past accumulation, the 5th year happens on or after assessment year 23-24, the law of computation as on the first day of the assessment year will apply, and therefore section 11.3 as proposed to be amended will be applied if the 5-year period ends any time on or after assessment year 23-24.
Right.
That would be my view.
Right, sir. Thank you.